With interest rates being so high, perhaps it might have surprised you that we didn't see a spike in listings from more mortgage defaults. Now, if high interest rates didn't break the housing market and we're probably in for a recession pretty soon, what do you think might happen to the real estate market? Well, in this video, let's find out. But before I do, check this out. This is a heads up that you can get our complete Toronto real estate investing guide for free on our website. You can see things like a breakdown of typical costs, rents, appreciation, sample financials that you can change up to see how it affects your returns, and even try out a quiz to see what might fit you best. I'll put a link to the free guide in the description below. Don't forget to like this video and subscribe to our channel so you don't miss other content like this made just for real estate investors in Toronto. Here's one perspective we've heard. We haven't seen many mortgages go into default even with today's much higher rates because banks have been pretty flexible with mortgage holders, offering them a variety of options and dragging out mortgage amortizations. So that means that most homeowners aren't actually forced to sell, and so we haven't seen the full negative impacts on the real estate market just yet. But once a recession hits, the people in this camp feel that higher unemployment will ultimately lead to more mortgage defaults and forced sales, and that's when we're finally going to see home prices come down. In theory, that could make sense, but it turns out real estate prices in recessions aren't as correlated as we think, at least over the last 5 recessions. According to historical data from Korea, prices actually rose by 1.8% on average from start to end during recessions, and the reality is that most buyers buy based on affordability. For long-term investors, it almost always comes down to cash flow and making sure they have strong holding power, which helps them reap long-term real estate benefits. Now, for end users, besides having enough of a down payment, they buy based on how much they can qualify for on the mortgage side and how much their monthly payments are. And all of these changes depend on where interest rates look like, and so interest rates end up being the biggest driver of real estate prices. Now, with 8 interest rate hikes going up a steep 425 basis points in less than a year, we've actually already seen a big downward price adjustment in real estate. And now that bond yields are coming down, fixed mortgage rates are going lower, and so this is what's giving room for real estate prices to climb again. Right now, recession expectations continue to grow, and instead of betting on another rate hike by September, the current bond market has now done a complete U-turn and is expecting a rate cut by July, and there's really good reason for that. The Bank of Canada decided to hold rates stable for the first time in a year this March, and the US Fed is also hinting that they're getting close to the end of their rate hike cycle, with the banking chaos as a key factor in their decision. Canada's PPI actually deflated last month, and Canada's CPI saw the largest deceleration since April of 2020. The BOC minutes from March came out as well, and it's revealed that all 5 governing council members think that the target rate should continue to hold because the economy is slowing and inflation is coming down. So all of these factors do point to interest rates probably heading down instead of up once it changes, and if that actually pans out, that should continue to give strength to real estate. Now, on top of this, in another video, we did talk about how big immigration targets might put more pressure on real estate values, and that was based on a growth estimate of 500,000 people per year. 2022's population growth data recently came out at 1 million people, double what was expected. So based on simple supply and demand, this should also drive home prices higher. Now, we have to be clear that we don't have the crystal ball, and we can't say for sure that we've definitely hit rock bottom and prices will only go up from here. We also focus on long-term investing and discourage flips. But if you are considering long-term real estate investing, the signs do point more so to positives than negatives for the real estate world, with interest rate expectations coming down and strong immigration targets. And Toronto's more mature freehold market can be your more secure option. Prices normally don't spike as much, but they also don't drop as much in a downturn, and that can be something important in more volatile times if you are thinking about lowering your risk. So, if you are interested in learning more about these kinds of opportunities in Toronto, we'd love to have a personalized discussion to learn more about your situation. Just reach out to us by heading to the link in the description below. We're a real estate sales brokerage that focuses on investing in houses and multifamily homes in Toronto, and here's how it's like to work with us. First, we'll do a discovery call with you so we get to know each other more and help you get your financing ready, and then we'll teach you how to analyze deals. Once you're set, our sales team will work with you to find the best opportunities on the market and eventually help you buy the best one for you. Houses typically need a bit of renovations and we'll help you with a detailed scope of work and contractor connections. And then once you're ready to rent out the place, we also have leasing and property management services if you need it. So if you want to learn more about any of this, just head over to our website at the link down below. Again, don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. You can also head over here to check out our other videos. Thanks so much for watching and see you in the next video.